Hi, this is Bill Bronchick, and in this video I want to describe the Series LLC, which is a neat entity that you can use to protect assets into multiple groups or multiple baskets to insulate them from liability and the liabilities of the other assets. So for example, what a lot of people do is if they have, let's say, 6 rental properties, they'll form an LLC to protect themselves from liability. And that's true. The LLC will protect the individuals from liability and protect the individual's personal assets. But that structure will not protect the real estate assets. You see, if you own a property in your own name and you own 6 of them and you get sued, you can lose everything you have because the judgment is against you, including the properties. If you put it in an LLC, okay, they can't get your personal stuff, but they're suing the LLC, they get a judgment against the LLC, they get all the properties the LLC owns, so it doesn't protect the assets of the company. And what a lot of attorneys will recommend is that you split up the baskets, meaning have a separate LLC for every property, and that way each property is owned by a separate entity, and the most you can lose is that one property that one entity owns. And that's not a bad idea, but that can get expensive, cumbersome, and a logistical nightmare because of separate bank accounts, separate tax returns, separate bookkeeping, separate records. It can become a real problem if you've got a lot of assets and a lot of properties. Now, the Series LLC was designed with exactly this in mind. The Series LLC, which was started in Delaware and is available in about 10 states, and it is available to use in states other than those 10 states. You just form it in that state, such as Delaware, and then you could bring it to your home state as a foreign entity and register it as a foreign entity. You can segregate assets into baskets called series. And they're almost like cells. They're not really separate entities. They're not separate LLCs. They don't file separate returns. They don't get a separate tax ID number necessarily. They don't have separate bank accounts. They don't have a registered agent. It's just a designated series or group of assets that are specifically tagged as this group only, Series 1. So, for example, if you had real estate, you could have XYZ Company Series 1 as the owner of one property, XYZ Company Series 2 as the owner of property number 2. And at least in theory, the statute in Delaware and other states says that the series property is not liable for the liabilities of the other series or the master entity, XYZ Company. They are completely insulated from each other. Now, unfortunately, there's been no case law that has reviewed this and said, yes, that's what it is. Most attorneys are a little skeptical about this because of the unprovenness of this in courts, but I am not one of those. I feel as though if you disclose the existence of the series, and that's the key here, and I'll describe how you do that in a moment, and you keep things separate and segregated in your accounting records and in the titling of the assets, it should hold up as a separate entity in a state court. And the reason this is because the analysis of separate entities, whether this be a series or whether it be multiple LLCs, is pretty much the same. The court's going to look at, did you keep things separate? Did you rob Peter to pay Paul in the accounting? Did you designate them as separate titled assets? Did you disclose the existence of these things to potential litigants? And it's the same analysis that would come into play, and if you keep them as separate and treat them as separate, you will have the protection likely if it goes to court. Again, it's not a guaranteed thing, but there's a balance between the practical realities of running your business and the legal perfection of trying to protect yourself. And I think this is a good mix, the Series LLC, and I use it myself because I'm convinced that if done properly, it will give you the protection that you need. So what we do is we disclose the existence of the series because the series itself is formed by paper. It is not registered with the state. So when you form a series, you form the entity itself, just like every other LLC. You form an articles of organization with the state, and then you create series by paper, by an agreement, by a mini operating agreement. Now, there's no registration of this series, so how does anyone know it exists? Is that fair game to say you can only get this one series assets if no one knows it exists? And that's a good argument. So, for example, what we do is, in the deed itself, we'll take title as XYZ Company Series 1, and then we'll put in the deed some specific disclosure language that says this asset is the property of Series 1 of XYZ Company, a Delaware limited liability company pursuant to Delaware statute section blah, 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 blah. This is a grouped or series assets which is limited in its liability, and you can't go over to look at other assets of the LLC or this other series to satisfy any judgments regarding the liabilities of this series. And that's a full disclosure to the world because it's on public record on the deed. Second, we make a tenant sign a lease agreement which has the same paragraph. They understand that the landlord is Series 1 of XYZ Company, that they're limiting their liability to Series 1. And contractually and on record, we are disclosing the existence of the series. It's going to be pretty darn hard for a court to say that wasn't fair. Now, the other issue is how do we deal with the separateness of accounting? Theoretically, every series should have its own bank account to keep the assets separate. And that tends to be when a court sets aside or pierces the corporate veil. They tend to look pretty hard at the accounting. Did the accounting look like a mess? Was Peter robbing Paul and so forth with the assets? Now, separate bank accounts would be ideal, but again, functionally a nightmare. So what we do is we set up one clearing account with the LLC. And that LLC account says XYZ Company for benefit of Series 1 through, and we say, assume there'll be maybe 20 series. So Series 1 through 20. And by the way, you can have as many series as you want. They're created by paper. There's no expense involved. When a tenant writes a check, he'll write a check to ABC Company or XYZ Company, Series 1. We deposit that into that bank account and note in the accounting records this is Series 1 property deposit. When we write a check out for taxes or repairs, we note that this is for Series 1. This is very much the way that a property manager who's a real estate broker would have an escrow account. They don't have an escrow account for every property and every client. They have one clearing account where they designate this income or this expense is related to this client and this property. And in doing so, especially if you use something like QuickBooks, it's very easy to just print reports and say, this is the distinct records of Series 1, this is the distinct records of Series 2, without having to deal with separate bank accounts for every series. In this fashion, if you keep it separate, if you keep it segregated, if you don't take Series 1 money and pay mortgages on Series 2 property, which would be a big no-no, you should be able to segregate assets with a very low expense, just one entity formed, and then after that you just create series by paper and segregate out your assets into multiple different series, groups, or cells to insulate the liabilities of one asset from the other. This is Bill Bronchick, and if you'd like more information on how to set up a Series LLC for your real estate and other assets, give my office a call at 303-398-7032. Thank you for listening.